Okay, so it's 2020. It's a year for the record books. A year that's going to be etched in our memories for probably the rest of our lives. It's probably the kind of year that's going to be written in textbooks for our kids, our grandkids, great grandkids, and it's only half over. And those of you who are on this today are getting kind of a preview of something that's to come. And if you read our quarterly message, you'll know what I'm talking about. But in the lower right-hand corner, you'll notice there's been a change in the logo / name. The entire brand of the firm is in the process, in the middle of changing from DeYoe Wealth Management to Mindful.Money. A letter is going to go out to everybody, all of our clients, not everybody, but all of our clients at the end of this month. Maybe August 3rd is that Monday. We'll probably send it out. By the way, that's Kate's birthday. I have to remember that. Maybe I should write that down right now since it's top of mind. But we're going to send a letter out on August 3rd for folks. That's going to explain some of the history, some of the reasons, some of the whys and how fors. And nothing is changing in terms of our services or what we're doing. We're just embracing this concept. I wrote about it in the book. It was published a few years ago. It's something I've always dreamed of and wanted to do. It also lays the groundwork, I think, for the next decade, 20 years of the firm itself. And there's reasons, and we'll talk about those reasons in that letter. But you're getting a preview because you see the logo here. The new firm's name is Mindful.Money. This is general information and education, and I have to say these kinds of things before we get started because invariably somebody has invited a cousin or somebody onto this, and I don't know them at all. I don't know anything about their financial situation, what's going on with them. So this can't be advice because I don't know everyone here. This is our philosophy, our belief in education, and this is our opportunity to inform. What we've always used this for is informing clients kind of our base case scenario, what we're thinking about, what we're watching, what items actually bear into our analysis and our thinking, and kind of what you can expect going forward. And that's pretty much what this is. But let's see here. And the things we always cover is we cover, where we've been. So what's happened in these first 6 months. And in looking in the first 6 months, we're actually gonna go a little bit further back than that and talk about some of the behavioral things around our responses to what's happened in this first 6 months of the year. We're gonna talk about where we are right now, and we are gonna talk about where we may be going, which is, I think, where you get a lot of the good questions. All right, I think we're kind of warmed up. I actually want to turn it over to Scott. Another trick question. Yeah, that's right. I want to turn it over to Scott. He's actually going to take us through where we've been. Again, before we launch into this, however, I want you to feel free at any time to ask a question live in the Q&A button. If we're not paying attention, raise your hand. If we miss something, raise your hand. There's a lot of stuff going through on chat. And we may miss something as it flies by, but just please ask a question. If you have anything, we'll stop in the middle of a slide and we'll answer the question. We'll also take a break between the 3 sections and we'll answer more questions there as well. So Scott, why don't you go ahead?
So I'm not going to have any access to chat and Q&A, but let's just jump right in. So I think this is a really great slide. Some of you may have seen this before, but I think it's just really good to sort of focus in on what's gone on for the last few decades when these kinds of traumas and crises happen. Because it's not the first time we've seen really ugly, nasty, uncomfortable things happen to the markets, the economy, and the average consumer out there. So if you take a look at this is showing you going back to '87, terrorist attack, dot-com crash, and all these other crises in between. What you can notice, if you look closely at the orange bar, what you'll notice is after these traumas have happened, any given year, it's kind of anyone's guess. No real pattern here. Sometimes things are up, sometimes things are down. 1 year is not really a time horizon. Most on the call should know that by now. But with a 60-40 split, what this shows you, if you look at the dark gray bar and the light gray bar, in most cases after 3 years, but certainly after 5 years, markets are significantly higher. And so what this is really showing you is the idea of sitting in cash for a few years and waiting for things to settle out, definitely not the right call for good outcomes. So this is really honing in on a half a dozen or more traumas we've seen and how markets have responded 3 and 5 years later, I think is where you want to focus. And I think it's a great chart. Okay, this one's also kind of interesting too, because now we're going back almost 100 years, almost a century. You see on the far right, the 9.6% annual rate of return. So that's basically what's happened in a diversified portfolio going back almost 100 years. Most people assume after a 10% decline, 15% decline, or a 20% decline, that it leads to further decline. And what this actual graphic shows you is it sort of almost flips the script. What it actually shows you is after 10, 15, and 20% declines, markets have higher rates of return than the norm. And if you look at every one of these bars, with the exception of one, they're all higher than the 9.6 we normally see. And this is going back a decade upon decade to show you this. So down markets don't lead to further and longer down markets. They actually have better rates of return than the averages. And I think that's really important to see here. This should be familiar to hopefully some of you. I think this really speaks to what my career has been like for 25 years. This cycle repeats itself, and then it repeats itself and repeats itself. I think elation is an interesting point to look at here. You may remember February of this year. Let's use the Dow as an example. Almost at 30,000, right? 29,568 or so. Elation. U.S. markets, S&P, NASDAQ, and Dow Jones, all at all-time highs ever seen before on U.S. soil. What makes what happened recently a little bit different than what we saw with, let's say, 2008 and other traumas is there really was no nervousness here. This went from elation to fear in 28 days. I'd never seen that in the quarter century I've been doing this for a living. So there really wasn't time to be nervous. It was just, what made this different, I think, than 2008 is the 28 days you saw here where this happened. If you go back to 2008, it took 18 months to go from elation to fear. So very, very different. A lot of comparisons being made. I think that's not one you can compare. Very, very different. And I don't think we're in fear anymore. I feel like we're swinging towards optimism. But I think this is a chart that you're going to see and a graph you're going to see. And this repeats itself and will continue to do so for everyone's investment lifetime. This has not really been changed at all. Okay, so let's talk about the first half of 2020. Lots of things to digest. Some of which don't necessarily affect the markets, although they're sad, like the loss of Kobe Bryant, things of that nature. But Brexit happened this year officially. COVID is the talk of the town, obviously, trauma there. But trade tensions, issues in Hong Kong, issues in China, Iran, et cetera, et cetera. So this is a lot for us to digest in just the first 180 days or so of the year. Most of this you're familiar with. I can assure you we'll see a whole lot more the next 6 months. Just some highlights here of what's going on in the last 6 months. So this speaks to the 28 days I spoke to earlier, where we went from top to bottom or peak to trough, full-blown bear market all-time highs to what happened in March. And normally that stuff takes a whole lot longer. The average drawdown is usually about 16 months. This one took 28 days. And it usually takes a whole lot longer than 28 days for the market to price in all the fear. It literally did it in a few weeks, as opposed to 16 to 20 months. So that's why the volatility was where it is. So speaking of uncertainty and volatility, so the blue line here is showing you the S&P, and the red line here is showing you the VIX or volatility index. And they usually go hand in hand, right? So you see the S&P at the end of on the far right here, S&P drops due to uncertainty and volatility due to COVID spreading throughout and beyond China. And you can also kind of look back to 2008, where you saw the volatility go a little bit off the charts as well, far left in the red, and they just go hand in hand. So volatility, unfortunately, and uncertainty go hand in hand. That's nothing new. We'll see more of that the next 6 months is what we expect. Don't want to spend a whole lot of time on COVID. You're probably all on COVID overload. I know I am. But this just gives you a sense for what's going on Earth and how these cases have shown up throughout the various continents and countries. We'll get more into this a little bit later, but at the end of the day, this is here to stay for a while. I'm not asking you to get comfortable with it, but we don't have a switch to just flip it off right now. So let's talk a little about GDP. So as you can see, for many quarters and actually many years, and it goes beyond 2016 to the left, we've had really strong growth across the board consistently. Cut to scene 2, COVID-19 hit. It's very obvious what happened here in Q1. We shrank by 5%. We do have an expectation as things settle in and there's a recovery, although it will not be a violent recovery, it'll probably be gradual. These kinds of numbers will continue to improve and get back to some version of normal. But at least for now, this gives you a sense for what happened in Q1. Q2, the print should be out momentarily because it is kind of over, and we're just waiting for those numbers to be officially announced. So this is kind of interesting too. This is sort of showing which states actually shut down their economies earliest. And you can see here, it looks like New Jersey on the far right, Illinois, and California, the dark blue, they were the ones that came to the table and made this happen quickly. And so their economies shut off first. They're going to be a little bit slower to come back. And you see some of the Midwest and some of these other states on the lightest blue, they waited a few more weeks to shut some things down. And so just giving you the landscape and what's happening in this country around these shutdowns. So this is showing us not just the blue chip consensus, which is this sort of light bluish gray, subtly moving, slowly moving data versus the Atlanta Fed. So the blue chip consensus, when it's measuring, it doesn't measure as often. And so what ends up happening is the movements are a lot slower. They're not as jagged, they're not as violent moving in up or down direction. And so that data doesn't come out as often, and that's why it looks like a much slower decline. You can see with the Atlanta Fed, which is this green line, where the drop is pretty violent and the recovery is also quite jagged as well. And it's because that data comes around a lot more often. So, weekly, daily, throughout the week, whereas the blue chip consensus, that data just comes out a lot more infrequently.
Scott, what would you say about the big difference between the two? I mean, the blue chip consensus seems so steady. The Atlanta Fed's, the GDP Now estimate seems just really, really rocky.
Well, again, I think it's because the Atlanta Fed, the data is fresher. It comes out much more often, and the blue chip consensus data is a little bit stale. So it would appear that things went down slowly when in reality, things went down much more quickly than the blue chip consensus would show you. And so, I would be looking more at the Atlanta Fed numbers because they're coming out more frequently, they're more accurate. But it would also, they're not going to be, none of this is going to be linear, right? I mean, you're going to have good weeks, good months, but you're also going to have some bad weeks and bad days. But as we recover, the Atlanta Fed is going to be much more accurate because it's getting you data more frequently.
Oh, here's a question that came into the chat. This is different. What is the Atlanta Fed? It's one of the Fed is Federal Reserve. It's one of the Federal Reserve banks, the one in Atlanta.
So there's several of them throughout the country. Jerome Powell oversees the entire Fed with his group, and they give reporting based on what's happening consensus-wise in various locales throughout the country. So on the left, you see things that are improving, and there's actually quite a bit of this stuff. Mortgage applications are really going extremely well. Record numbers on some level for those realtors out there. A lot of good happening there. Real estate certainly hasn't fallen off by any means. Again, it's all local, but from what we see locally here, we haven't seen a real fall off at all. Jobless claims have been improving, but things like what would say, restaurant bookings, airline bookings. So I believe it's, what is the, Jonathan, what's the restaurant booking company?
Open Table.
Right, so Open Table gives us this data around restaurant bookings. And although things are not great, they have been improving dramatically since March when nobody was doing anything. Airline bookings, again, also not great, but a lot better than they were when they had literally 100% emptiness going on there. So in general, a number of things are improving, but there's still some things that are waning and or struggling. Obviously, COVID cases are ramping up again. Same store sales and a lot of retail still struggling. Oil rigs should speak to the obvious, and that is there's just a lot less demand, a lot less cars on the road, a lot less cruise ships doing their thing and so forth. So that's going to take a while to recover. And there's some very specific sectors, leisure, hospitality, and I think a lot of these. They're going to take a while longer to come back. And so those areas are still having a hard time.
So we did get another question that came in, and I'm just going to read the question. It says, what I see in Atlanta Fed figures is not completely explicable by more frequent sampling rates. Do Atlanta Fed and the other system measure the same thing, or is there difference? Do you want that, or you want me to take that?
You can take it.
So every Fed and the blue chip consensus includes not just Fed, that's private, it's economists, it's survey data. So every Fed has its own survey. The Atlanta Now is one set of surveys that talks about up to the minute data, or up to the day data. But it's different measuring things from lots of different things. So one of the things that I always talk about when I show both of those things is we talk about how what's the phrase? Figures lie and liars figure. You can, from whatever bent you have coming in, you can find data to support your notion of the way things are going. You can find immediate data that says, yeah, things are getting better. You can also find immediate data that says things are getting worse. And that's one of the biggest challenges in communicating with a public that just is not economically aware, because politicians have a fantastic day with this kind of stuff. And you saw this in that interview with
Trump.
What's his name? Chris
Wallace
and Trump. They both pulled out, yeah, we're doing the best. Trump, we're doing the best. Wallace was like, nah, we're like one of the worst. And it's just, they both were drawing from two completely sets of data. They were both publicly available data sets. They were both looking at graphs. Trump was looking at 5 countries. Chris was looking at 20 countries, which is a little bit more, accurate in terms of the representation. But yeah, the data that is collected by all these different places is often different data. And it's you have to look at all of them to get a good sense.
Yeah. Okay, so unemployment. So everyone, I think, is pretty aware that we lost somewhere between 20 and 30 million jobs in April. I guess that was March, excuse me. And what we've seen is a real steady decline in those numbers and the reported unemployment numbers. And so, as I said earlier, it's not going to be linear. You're going to have some months that are a little choppy, but on the margin, it looks like things are slowly repairing themselves. The difference between these two lines or these two bars, the blue one is just the general unemployment rate. And what the red one is really talking about is people that are marginally attached, people that maybe have a master's, but they're a barista currently or doing something that is not being at full employment, and so forth. And so they're a little bit different, but the trends are very similar. And so I just wanted to speak to the fact that this is definitely going in the right direction. And but things were really pretty uncomfortable to look at in March, that's for sure.
Are we expecting, Scott, that this is just going to keep its trajectory straight down in this fashion?
No, Jonathan, we're not expecting it to continue to go straight down. We may have an outlier month where something happens where these things spike again, but in general, month over month, quarter over quarter, these should be continuing to improve. Obviously, we need a vaccine or some kind of medical intervention to really change the script right now. But on the margin, things look like they're improving.
Yeah, we had a question come into chat. The implication seems to be that the historical record supports the belief that the decline will not last more than a year or two, but the decline occurring in 28 days, which is unprecedented, won't that affect the validity of the historical record?
Well, so we've had down markets that have actually happened and didn't last 18 months to get there. The average going back literally to the 20s is about 16 months. But as an example, I'm just trying to think of a good one. I guess this is probably in the 80s. You had a 3-month decline of 30%, and it happened in 4 months, 3 months. So things happen not on average of 16 months. Sometimes they're longer, sometimes they're shorter. I think what happened that makes this feel so profound is we were lulled to sleep. The average drop of 20% happens generally every 3 to 5 years, give or take. We had 10, 12 years in between the last time this happened. We forgot. Humans get complacent. That's the way the brain works. And we just forgot that this can happen. Even though we've seen it over and over and over again, including folks in the business and have been doing this their whole career, you get lulled to sleep. And I think the reason why this one was so shocking is because the last time this happened was 2007, 2008, a long time ago. But I think these kinds of traumas, which we talked about earlier, they always have different names, terrorist attack, tech bubble, whatever you want to call it. They generally draw down between 20 and 40%. They've always been temporary with no exceptions. We do not believe this is going to rewrite history, although it feels very uncomfortable, as every bear market does. They don't ever feel normal. But when they're over, you look back and, oh yeah, it dropped 25. Oh yeah, it dropped 33. And now we're back to new highs a few years later. It's been 100 years of history that's shown this. Betting against the U.S. Economy has been a horrific bet over the years. I would not start today. I hope that answers your question.
And another question came in. It's, unemployment claims are lower, but are jobs being added? I mean, I guess I could take that question in two different ways. One, are there new companies starting and adding jobs? And I would say, no, not yet. That will happen, but not yet. But are there jobs that went away that are coming back? Absolutely. I have two quick examples. One, I'm a very small investor in a retail game store, and they shut down in March. They were told to shut down. They could not do even curbside delivery, and so everyone started getting unemployment benefits from the state, from the federal government, and the owner started doing deliveries. He'd go to the store. He would, take online orders, and he would deliver that order, 14, 15 orders a day for 2 months. But they did just open up, and they hired 2 of their old employees back, and then some employees didn't want to come back, so they hired, because they had great benefits, and so he hired a couple other people. And now that might be shifting again, because it's gotten kind of hot, so people may not want to come into the store anymore. So that's one example, is those jobs went away and then they came back. Another example is Eli, my son, works at Saul's, and he worked at Saul's a little bit over the summer, and he was gearing up to work there, and then Saul's shut down. And then Saul's opened up like last Tuesday, and he was part of Eli's going into work. He was going in 3 times a week, Tuesday, Thursday, Sunday, but business hasn't picked up as much as they'd hoped. So Eli, and this makes perfect sense, he should be the one that doesn't get to keep the shifts. And so he's coming in on Sunday now. He's not going in on Tuesdays and Thursdays. So there are jobs that are coming back. Most of the jobs that are coming back were from companies that were a little stronger to begin with, and had the ability to withstand 2 months, 3 months, 4 months of no revenue or much less revenue. At the same time, they really drastically cut their expenses. So, hopefully a lot of these businesses survive. We know, though, that many of them won't. So there aren't new jobs being added in places. Well, U.S. Postal Service.
I'm sure Zoom's hiring. I'm sure a lot of these tech companies are hiring, right?
Yeah.
It's just fragmented, and it's not keeping up with some of the job losses. But there's definitely people getting added, for sure.
Yeah, for sure.
So just to hit a finer point home on some of the purchasing that's going on and new orders. So the gray bar here is showing you new orders. A number below 50 is somewhat problematic, and above 50 is heading in a good direction. You can see here in April, really had a hard time. I think we almost, not quite 25, but almost half of where we want to be. We've had a pretty tumultuous rise just in the last couple of months. Above 55 is what it looks like there. And so, again, the trend is on point. It looks like it's positive. It's going in the right direction. It will be jagged. It will not be perfect. But we're certainly not where we were in March and April. That's for sure.
Okay, a question came in the chat. I'm just gonna read it real quick so everyone has it. There's been a total disruption in the way people work, which will result in additional structural unemployment. This may be very long-term until there's a total reorganization of the way especially knowledge workers work. There's a reassessment in the need for commercial real estate, and these vacancies will result in unemployment for service personnel who serve office workers. Yes, I think that something like this, and specifically around commercial real estate, you're going to see some changes. I think that there's room for let me take it this way. So for the last 10 or 15 years, I know lots and lots and lots and lots of businesses that wanted to start up that said, no, we're not going to start up because we can't, or we're not going to start up here because we can't afford real estate here. So I think there's a price function that can manage a lot of this, the potential open space. Now, one of the problems with that price function is a lot of the people who lend on commercial real estate put covenants in place that say that your average rent has to be at a certain level. And if that covenant, if you break that covenant, then your loan is callable by the lender. So to the extent that we have a recent commercial real estate purchase that has that kind of a covenant on it, they aren't as free as other buildings to reduce their rent charges. But those older buildings will be able to reduce their rent charges, and there will be some buildings that, we see companies declare bankruptcy And then somebody else will be able to buy those buildings at a lower price. And that covenant that they have at that point will allow a lower rent point. So there's the price function in commercial real estate. There's no question that there'll be disruption. There's no question that it'll be hard for lots of people. But the price function in commercial real estate works in both ways. When the prices get really high, as they are in the Bay Area, you see a lot of construction, you see a lot of businesses don't start. When the price function shifts and prices come down, you see the opportunity for some business to start, you see less construction. And those two things are going to work together to mitigate a lot of the long-term problems. The question about structural unemployment relative to knowledge workers, I actually think that there may be an opportunity for knowledge workers to work from anywhere on the planet for any company, because there's a huge upside to this. In that, not saying there's no downside, there's also a variable on the upside, in that Twitter says, hey, we're not gonna force anyone to come to work in San Francisco ever again. You're always going to have the opportunity to work from elsewhere. And so what you're going to see, what may happen is you'll see some of these people move to other parts of the country. And the first effect is they'll have lower cost of living. The second effect is there are only so many beautiful parts of the country. And as people move to those beautiful parts of the country, you'll see different groups of people come together. And in those groups of people, they will create different new things. Facebook was created in a dorm room. And Twitter was created in some incubator in Silicon Valley. So these things come out of the combination of intelligences, and there's going to be new combinations of intelligences when people leave the Bay Area and go other places. So I think that immediately there's definitely costs and risks. Long term, I think you see a lot of opportunities that come out of this kind of a thing. I hope that kind of answers the question or touches on the question.
So we talked a little bit earlier about what's happened to spending, but let's talk about spending, personal income declining, and savings, which will come up, I guess, in the next slide. But what we saw again in April is a real decline in spending, for kind of an obvious reason, and everybody was just kind of home, and you couldn't. I mean, unless you were doing some kind of takeout, there wasn't a whole lot of money to be spent. So spending definitely did come down in April. We've seen a pretty strong recovery already in May and June, although this chart doesn't show June. Incomes have come down, absolutely have come down in the last couple of months. The government looks like they're going to extend some programs around unemployment, around those checks, $1,200 checks. That's all getting finalized. I don't think the ink's quite dry yet, but that all is coming as well. So definitely an improvement in spending off the bottom. We expect that to continue. Yeah, so this really speaks to when the money was sent out to various folks in the country, it was a one-time benefit. And that stuff, as you may know, is set to expire literally within a couple of days. So even if the hiring continues and wages keep rising, there's still going to be this shortfall potentially of 3 to 4%. We're hoping that that hole can get plugged with an extension of the checks, with an extension of unemployment. Even if it's not 100% of the extension, even a portion of the extension should help insulate as we try to navigate through COVID-19.
So another question came in, and I don't know if this is tongue in cheek or not, but I'm going to answer it as if it's serious. How do we see manufacturing companies moving back to the U.S. from other countries affecting job growth? So I think that the reality of that is pretty heavily overpromised. I do think that on the margins it happens, and we are seeing some of that occur. I think the pandemic has basically put a complete stop to any of that kind of movement, because there's going to be price differences for manufacturing wherever you go, whatever tariffs are in the next 6 months to a year, relative to outgrowth of the pandemic. So there are going to be places that you'll be able to hire people for a lot less money than you're able to hire people in the U.S., even if there are big tariffs. The other thing is these companies they're looking at this. They have to be thinking, and we're going to touch on it briefly, but not right now. They have to be thinking about the election cycle and the fact that when Biden wins, which is, fingers crossed. When Biden wins, we return to being a better global citizen. And if we're a better global citizen, then the idea of manufacturing jobs returning to the US, that idea is probably not a reality. It's probably not as strong a reality. It never was a strong reality to begin with, but it's less strong when we're playing better on a tariff basis with our trading partners.
This is just showing all the various active business owners in the country and how they've been adversely affected since February to April. And it's just showing you, both men and women, all the different kinds of folks throughout the country and how they've been affected. The theme here I see is nobody was immune to this. At best, down 15 to 20%. At worst, down over 40%. But everybody's participating in the trauma thus far, which again, likely based on history to be temporary. But it just gives you a sense for the landscape of who's getting affected by this and how.
And I think we do. I think we should probably voice there is an extreme difference between white folk and Black folk and Latinx folk in their businesses here. And we also have a couple questions coming in specifically to the repercussions of. I'll just read this first one. What kinds of repercussions should we expect if the government does not extend the additional $600 per week, which is what's basically making unemployment barely enough to live on for service industry workers, for example? And the next question is related, so I'm just going to read it first. We've got a number of friends totally dependent upon unemployment. Do you have any information on the likelihood of a renewal of the COVID benefits? So we've been saying, for weeks now, there's been a lot of people worried about there not being an extension. There's going to be an extension. If you remember back to 2008, when we had to do something to bail out the economy, or the thing was going to go to zero, and the runner wasn't going to get up off the track, using our favorite Warren Buffett references. And it took us 12 months of QE this and QE that and 5 attempts and lower rates to make it happen, because Congress argues, and they always argue, and they never come up with the best possible solution, but they always come up with a solution. Each side entrenches themselves, and then they have to kind of meet somewhere. And I have someone else popping in a chat here that California, if Congress doesn't act, California may offer $600 a week in extra jobless benefits. And that's the kind of thing you're going to see if Congress doesn't do something. Most states can't do that, right? California can do that. We can borrow. We are a very large economy. But there will be an extension of benefits. It may not be $600 a week. It may be $500 a week. It may be $400 a week. I know that there is going to be something that comes down the pipe. And in California, it looks like somebody's saying that California might make up that difference, which is I think would be a big deal. It's very interesting. I am, as you know, for me, this is precisely the time that the federal government has to step up and spend money. There are other times when I actually disagree with a lot of federal spending, but I disagree with federal spending in those times because this kind of thing happens. 2008 happens. The federal government has to be prepared to support everyone that needs to be supported. States need more money. Individuals need more money. We don't have a choice. People can't go to work. This is something that has to be done. The reason we are conservative the rest of the time, to an extent, is because there are times when we have to spend money. This is that time. I do not believe, I would be shocked if they didn't come up with something. Again, I don't think it'll be $600 a week, but they will pass something, and it will be in everyone's pocket, including an additional $1,200 special assessment or special amount of money as well.
So again, because folks couldn't do anything in April, you could see savings rates were 7, 8, 10, 12% the first few months of the year. But the minute we were on lockdown, those numbers like more than tripled in some cases. And so we have the highest savings rate we've had in many, many decades, many, many years, which is going to have a silver lining when this is all over as well. People are going to be saving a bit more, hopefully putting away more for the future. And it's just a very different number in April than we had the first few months of the year, which we thought was kind of interesting. Major increase in savings.
Yeah, and I think that one of the benefits if you fast forward to, hey, we're not going to get the $600 or whatever the outcome is approved this week. One of the benefits of having that excess savings in March and April is we have a little bit of money in the bank to afford rent. So there's all kinds of statistics around what, the number of mortgages that are in forbearance or deferral, and the number of people who are renting their places that aren't paying rent. Those numbers, while were horrible in March, they're getting better. The number of home loans that are in some kind of a deferral or forbearance program went from like 9 or 10% down to 7%. So it's still a big number. Not 7% of all the mortgages is like 20 million mortgages. So it's still a lot of mortgages, but it's about 60-70% of what it was. So things are improving on that space, which suggests that people have the money to spend that they need. There's a whole nother group, about half the population requires the income that they're getting from their service jobs, and those service jobs are not there. They're the ones that need the $600 a week. And it's great to see that California is going to step up and hopefully fill that difference.
This is sort of hard to believe, but maybe not so much. But half of the Americans out there, half of the people in this country, don't have enough to pay a $400 emergency expense. So what this speaks to is, when we've sat with hopefully a bunch of you guys, gals are on the phone and so forth, what this speaks to is why the emergency fund. Why do we put 3 months minimum, 6 months in some cases, 9 months, 12 months, and depending on the client, up to 2 years of cash on the side? So that when COVID happened and the markets drew down 38% in just a handful of days, you're not drawing on portfolio that's dropped 30, 40%. You're drawing from this cash. While portfolio repairs itself and comes back towards break even and beyond, you're not drawing on assets that are depreciated. You'd be literally selling at the bottom, right? That's the whole reason why we do this. And I think everyone's aware what happened in March will happen again. Usually every, like what I say, 3 to 5 years. And so having this aside, that emergency expense fund, so to speak, 3, 6, 9, 12 months or so, super important, and became really evident and abundantly clear to folks that didn't do that. So if that's not the case for anyone on the phone, we'd be happy to talk to you about that offline to firm that up, because it's important that that's there. Because this will happen again, for sure. Don't know when, but it will. Jonathan?
So quick question came in, and it just about the how much we should have in our emergency funds. Someone asked, is keeping, always heard that 6 months is the right amount of backup money in the bank. It is very specific to your plan and how old you are, and where, if you're relying on that income stream or that asset base for your income stream, actually I would say between 18 months and 24 months is probably a better idea. If you're young, your expenses are low, you don't have kids, maybe you're single, 3 months is probably enough. So it kind of changes throughout your life stage, but it's definitely something you always want to have, that emergency fund on the side, and you want to have it liquid and in cash available for whatever happens.
That's right.